Hello there. You're welcome to today's webinar. Each webinar should have a theme, I guess, and this is not an exception. So, we are looking at crypto trading demystified. We're demystified, meaning easy to understand. Alright, so without further ado, we are going to get into actions. Okay, one of the questions I always get from intending traders and new traders include, how do I make money trading crypto? Most persons ask me, how do I start trading? I got a question yesterday from somebody who asked me, how do I understand the charts? Well, if you stick around, we are going to answer these questions and many more. For those of you who don't know me, my name is Gilbert Joekpata. I'm the founder of Smart Investors Lodge. We have trained lots of students whose results as investors and traders makes us proud. So let's look at what you will learn. You will learn what cryptocurrency trading is. You will also understand cryptocurrency exchanges and languages. This is very important. Why are you learning the languages of the exchanges? In the financial market, we actually speak a language, and if you don't understand what we speak, you're going to have serious language barrier. So we are going to cover some of the basic languages and words you're going to hear once you dive into the cryptocurrency market. We'll also look at understanding and interpreting your charts. Definitely, somebody asked me these questions, like I said. So that was Friday. This will be of great importance to you. So stick around, and we'll also look at common mistakes to avoid as a trader. This is very important. If you understand this and this and this, and you miss this, I'm sorry to say, I'm sorry for you. So stick to the end of this video. So let's look at cryptocurrency trading. What is cryptocurrency trading? People who buy and sell their assets on the short term are called traders. They take advantage of the short term market swing to make profits. So what differentiates these guys who are called traders is they are only interested in going in and out of the market from seconds to minutes to an hour to hours. Some hold their assets in a day or some few days to a week. They are just interested in, for example, Bitcoin could be selling this night for 9,200, and they know the next day morning, once they have done the analysis, Bitcoin could possibly be selling for $9,500. Are you with me? All right, I will go ahead. Most traders, they don't care about the technology or team behind an asset. They are not interested about this. Most of the traders don't care. All they are looking for is how to technically go into the market and out of the market at profit. So the short-term profit, the short-term money they are going to make is what is their interest, unlike investors. So it's good you also know who investors are. So let's go ahead. While investors buy and hold for the long term, believing the price of this asset will rise to maturity regardless of the short-term price swing. So you now see the difference between traders and investors. Investors don't care about the fact that Bitcoin is selling for $9,200 this night and tomorrow is going to sell for $9,500. They don't care about the short-term price swing. What investors actually do is they get their money and invest in companies, they invest in projects that are still young, knowing that once this company rise to maturity, knowing that once these companies start being a profitable company, the value of their asset, each or token, the whole, is going to increase in value. So investors believe in the technology, ideology, and team behind such crypto assets. So whatever crypto assets they are holding, they are quite interested, and they have to believe in the technology, the ideology, team which is behind such an asset. Okay, without further ado, let me let you know why people prefer trading cryptocurrencies. Like you already know, the traditional market is there, which is the stock market. We also have the commodity market. There is also the forex market. Why do people prefer trading cryptocurrencies? One, volatility. The change in price of crypto asset happens rapidly, so you can make great profit if you're well positioned for the ride. Yes, the changes in cryptocurrency asset price happens with speed. So this actually means more profit. More profit for you, because it is the changes in price of an asset that makes you money. If an asset is not moving, where are you going to make money from? Is the ups and the down that you make your profit from. So when the asset is down, you buy. When it goes up, you sell, and you repeat the process over and over again. So the cryptocurrency market is a 24-hour, 7 days a week market. So unlike the traditional market, cryptocurrencies are traded 24 hours, 7 days a week. Whenever, any day you want to make money, any day you want to make profit, at any time you could go into the market. There are buyers and sellers, and your exchangers are more than willing to do and pair both buyers and sellers together. So this means money anytime, any day for you. And another point I put down here is quick settlement. Yeah, this is the third point, quick settlement. The cryptocurrency market is largely unregulated, purely unregulated, and this makes settlement of contract very easy to execute. All right. So let's look at types of traders. If I had to pick these three major type of traders, because I know you will find bearing and you'll find foundation in one of these type of trading strategy. The strategy you use when you go into the market defines the kind of trader you are. So first, we have scalpers. Scalpers that seek profit in little time change and little time frame. So they go into the market, in and out of the market at profit, to make profits within seconds to minutes. Then we now have day traders. Day traders, they seek profit on daily price movement. So in a day, an asset changes in price each day. So they make sure the change in price for a day, they make profit out of those changes. And they don't stay in the market for more than a day. At the end of each trading day, they close their trade. And then last but not the least in my list is the swing traders. I'm not going to talk much about swing trading because I'm a swing trader, so I would not sound a little bit biased. What is wrong even if I get biased? Okay, swing traders, what we actually do is we spot the beginning of trends and we hold. Markets always move in different phases, so we always look at picking the trend when a new phase is beginning and wants to rise to the top. So we pick these trends when they just begin, we spot them, we hold, and let our profit ride. So most time we hold our trade from days to weeks. We make sure as long as this asset is riding in profit, we stay in the ride till it signals us that there is a trend reversal. Look, the trend is changing. We are no longer going up anymore. We are going down. And the advantage swing trading puts for you is you don't have to stay at your chart all day, all time. So mostly if you don't have all the time to stay at your charts, or you have a day job, or you already have some other business you're doing and you want to learn the skill of trading or start trading, swing trading is a good spot, it's a good type of trading strategy you will want to learn. Are you getting me? Are you with me? All right. So to make correct price projection, there is something traders always use. So how do you know that the market is going to go up, or how do you know the market is going to go down, so that you could take positions accordingly? When the market is down, you want to buy. Once it go up, you want to sell. You rinse and repeat. We always use two tools which actually help us make this decision. One is fundamental analysis, and the second is technical analysis. All right, so fundamental analysis, what these guys who do fundamental analysis do is they look at the technical side of development of the token. They look at news, they look at regulations, they look at the team and the issues that will affect the price. They also believe in the ideology of such a token. Definitely. So these guys are basically focused on the technology, ideology, and team behind any assets they are investing or trading on. Then the guys who use technical analysis, this side actually study price, sharp patterns, they study trading volume and statistics, because since price movement speaks for themselves, they tell a story of what will happen. A friend of mine was talking to me the other day. He told me technical analysis is a self-fulfilling prophecy. Okay, so that is his ideology, and I wouldn't argue for or against. I just had to share that with you. Cryptocurrency, exchanges, and languages. So what are cryptocurrency exchanges? These are marketplaces that matches buyers and sellers order. So what these guys do is when buyers and sellers meet in this market, it's a worldwide market anywhere in the world. Whether you're in the US, you're in Nigeria, you're in Zambia, you're in Ghana, you're in England, you're in Russia, we all meet in this marketplace. So buyers are buying and sellers are selling. Automatically it matches each order. So this is actually more of a practical session, and we are going to make it practical. We're going to look at what order book is. We'll look at limit order. We'll also look at market orders and bulls and bears. This is actually going to be interesting. Stick with me while we make this a time of great value and entertainment in simple forms for you to understand. For the purpose of this webinar, we are using Binance.com. I recommend you meet with Mr. John, or Mr. John will drop a link for you to register automatically. I recommend this exchanger for you. So once the link is dropped, register with the link immediately. One thing that sets successful people apart is the ability to take actions immediately. Don't procrastinate. Procrastination, they say, is a thief of time. So you have to register. Check this out for yourself. So you familiarize yourself with the cryptocurrency exchanger and also some of these languages which I'm going to introduce you too. So this is Binance.com. This is a trading pair, Bitcoin USDT. USDT is a stable currency. This is what the marketplace look like. You're going to see this is the trading pair. This is the price of Bitcoin right now. The price of Bitcoin is determined by the price somebody just bought. The last buyer's price appears here. The next thing you see is the 24-hour change. This is the change in percentage in the past 24 hours. You're going to see it right here. Over here is the 24-hour high. In the past 24 hours, what is the highest price Bitcoin has reached? You can see it here for yourself. This is $9,232. Over here is the 24-hour low. In the past 24 hours, what is the lowest price Bitcoin have sold for? Then also in this particular market, the 24-hour volume is the total transactions that have taken place in and out of these exchanges. The 24-hour volume appears right here. So you could choose to look at this chart in minutes, in hours, in a day or days, in a week to a month. But for this illustration, we are going to use the 1-day chart. Another crypto language you should learn and understand, because you will see this more often, is the order book. So this is your order book. You could see right here, this green, the numbers in the green are the numbers of buyers. So before further ado, what is an order book? It is the complete list of buyers and sellers. So this is the book. Why this is the prices at which the prices at which people are willing to sell. All of it appears right here. So if you want to buy, this is what you do. You can choose the best possible price. The best possible price is what appears here. So if you want to pick the order of this particular person, all you need to do is click on it. It appears right here. So right away, I'm going to take you to something else, which is called limit order. Limit order is buying a cryptocurrency at a specific price. Should I repeat that again? Alright, I will. When you buy or place an order to buy a cryptocurrency or an asset at a specific price, if you have your pen or jotter, that's a good place to take notes. So what you do is you click this price, which was the best possible price here. It appears here, and you choose either the amount of your portfolio you're taking to the market, either 25%, here we have 50%, right here we have 75%, or 100%. 100% is all of the amount of USDT you have, which you want to use to buy Bitcoin. All you will need to do is click buy. Or assuming you're not interested in the particular price that is here, you think the price of Bitcoin is going to come down, you can put the price even if you want to buy for $8,000. It's as easy as doing this. Then you set an order to buy. Once you click this, an order will be set. So if the price of Bitcoin comes to this price, don't forget you're buying at a specific price. The order is going to be executed. But without further ado, let's look at market order. Okay, market order. You see what I did? I clicked on this market order. You see, market order is buying a particular crypto at the best possible price. So this order is always fulfilled at the best possible price. What you do when you come here, you click market order, you just choose the amount of your portfolio you need. Maybe you're using 100% of your portfolio to buy. For example, you need let's use 10 BTC. This is what happens once you click buy BTC in market order. If you notice, in this order book, there is nobody willing to sell 10 BTC. So what it will do is it will pick all the best possible price and buy Bitcoin for you. So the disadvantage of using market order is you can end up buying Bitcoin at $9,158, $9,400, $9,600. All the best possible price will be picked. So at the end of the day, you end up seeing you have bought Bitcoin at different prices. And so I just think if you want to use market order, you need to be careful while you use market order. Okay, let's come back to our slide. I'm going to introduce you to bulls and bears. When you hear traders call the word bulls, we are talking of buyers. If we say bears, we are talking of sellers. So when we say we are bullish or the market is bullish, we mean the market is green. The prices of Bitcoin is rising. Why we say bearish, it means sellers have taken over the market. The market will be red in color. It means the prices of assets are coming down. All right, stick with me. We are going to move over to another very interesting topic, which is the Japanese candlestick. The Japanese candlestick is also known as OHLC. Let me tell you the meaning of this. O stands for open, H stands for high, L stands for low, and C stands for close. So once the market opens in a candlestick, there is a point it opens, the candlestick goes to a high for the hour or day you're viewing the candle. We have the low and we now have the close. Don't worry, stick with me. This is going to be a practical session. So the Japanese candlestick pattern was introduced by a Japanese rice trader called Munaisa Homa, however this name is pronounced, in the 70s. So if the candlestick is green, it means the price closed higher than the open. If it is red, it means the price closed lower than the open. So in a bull market, most of the candlestick will be green. In a bear market, most of the candlestick will be red. All right, just stick around. Let me show you this more for it to be simplified for your understanding. That was why we actually choose to make this a video class rather than text, like most of you would. Like I heard most persons were expecting a text class, but we want you to see these things for yourself. All right. So this is our chart, and we are in a wonder chart. So each of these candlesticks shows you a trade for the day. It contains all the information and activities that took place in each day. So we made mention that in every candlestick we have the open, we have the high, we have the low, and the close. So this is the open. You can see right here, not this bottom width, not this red width. You see this line. This part is the open. So at the beginning of this day candlestick, the market opened at this point. It closed at this other point, this part of the candle. Why this down width you see, this green width at the end, is the lowest the market went for this trading day. And this green width you see at the top of this corner is the highest the market went for this day, which is the high for this day. Okay, let's take this again. Should I? All right, I will. This part, you see this part is the open. This point is the close. This point is the lowest for this trading day. This point is the highest for this trading day. Are you with me? Don't forget, I say if the candlestick is green, it means the price closed higher than the open. So the price opened here and closed here. This was our low and this was our high. So over this was another trading day. Don't forget I also said if the candlestick is red, it means the price closed lower than the open. So now this candlestick, this red candlestick opened here and closed here. So the price closed lower than the open. Why? This is the 24 hours low for this day and this is the 24 hours high. So we could do this over and over again for each of these candlestick. This candlestick opened here, it closed here. This was our low for this day, this was our high for this day. Over here we have a red candlestick. So you see it opened here, it closed at this point. This was our low for this day, and this little width on top was the high for this day. So each candlestick tells us a story. We use the story to understand what the market is doing, what the price is doing, the actions of buyers and sellers in each given market. Followed up to this point, because we are going to share common mistakes you have to avoid as a new trader. One is don't risk more than you can afford to lose. This is very important. I'm sure most of you would have heard this before, but what differentiates most successful traders is that they understand the meaning of this. While the remaining 90% of traders don't always understand what this means. You should not risk more than you can afford to lose, not that you're going to lose the money. But this is because if you put more than you can afford to lose, you are going to make decisions based on emotions. And as a trader, you don't want to attach your emotions when you trade. You want your decision to be based on sound logic and scientific approach, which is determined by your strategy or technique as a trader. Let me tell you a story. I had a phone call from one of the members of Smart Investors Lodge. He called me telling me he has some millions of naira. He wants to trade in the market for like a month so he can make some profit out of this. But he told me this money, he wants to start a business with this money. And I told him, in trading, money management is very important. So if you have set aside this money to start a business, in the next 1 month, let the money be kept aside for your business. I went ahead to tell him if he was going to make profit, he will not have any reason to reach out to me. That even if I give you good profitable trade calls, I won't be there to be able to enforce good risk management and discipline as well to it. Knowing quite well, this money is meant already for a set aside project. He won't feel comfortable if he has losses in. Alright, I hope I explained this well, which I know I have. So don't take any money you cannot afford to lose, not because you're going to lose, but so you could make sound decision void of emotions. 2. Set a clear plan. When you go into the market, is good you have an entry point, an exit point, and a good stop loss. Should I take this again? Alright, I will. Have a clear plan when you're going into the market. Have a good entry, already have your exits, and have a good stop loss. Learn from your mistakes. All right. Most mistake most traders make is that they don't learn from their mistakes. How can you learn from your mistake? You need to journal. Journal is writing down why you took a trade, the outcome of the trade. So you could always, your journal is like a self-tutor. It's like yourself teaching yourself. Once you make mistakes as a trader, it's not about the mistake, it's about learning from the mistake. The more you learn from your mistake, the more you grow, and the more you better your skill set as a trader. Because like I keep telling people who care to listen, trading is a skill set. All right, last but not the least, don't leave your money on an exchanger if you're not trading. All right, listen very well to this. Most time you could lose your money not because you have losses, but because somebody could have unauthorized access to your account, or most exchanges are not insured. So in this case, hack could come into the exchanger could be hacked, and it means your asset could be gone. All right, this brings us to the end of today's webinar. Without further ado, we are going to take questions. So feel free to ask your questions, and then Mr. John is going to drop a registration link for you to sign up for the exchanger. All right, he will drop it in the chat session, and you could also DM him, direct message him to get your link so you could practice. And if you still have further challenges, we are more than willing to be of assistance to you. So over to the next section. It's time to welcome your questions.